1.1 Introduction. Businesses may undertake many different financial transactions every day: credit sales, credit purchases, cash sales, cash purchases, other expenses either paid from the bank or by cash, paying cash into the bank, withdrawing cash from the bank and owner's drawings. These transactions are recorded on different business documents and are entered into an accounting system. Sales, purchases, and expenses. Sales of goods or services and payment for purchases and expenses can be made on a cash or credit basis. Cash sales and purchases are straightforward, but credit sales and purchases require more accounting knowledge. Dependent upon whether we are the seller or the buyer, dictates whether we view the transaction as a sale or purchase. Cash sales and purchases. A cash sale or purchase will normally be made in a retail environment. A customer will enter the shop, choose the goods they wish to buy, then pay for them at the till. The seller will tell the customer the price of the goods, and the customer then offers payment for them in the form of cash or a debit or credit card. Once paid, a receipt, usually printed automatically, will be given to the customer. The transaction is now complete. For credit sales and purchases. The procedure for a sale or purchase on credit can be a bit more involved. The sale or purchase process will normally be initiated by a seller receiving an order from a customer. The purchase order from the customer may be in writing, over the telephone, by email, or via a website. The first decision to be made is whether to allow the customer credit for this sale, i.e. the period they can take before paying the invoice. Offering credit selling goods on credit involves an element of risk. The goods are delivered to the customer with the promise of payment in the future. The business must be confident that the payment will be received. The decision process as to whether to make the sale on credit will be different depending upon it being a new or existing customer. Existing customer. If an existing credit customer wishes to make a further purchase on credit, it would be normal practice to conduct some basic checks. When the customer was originally accepted as a credit customer, a credit limit will have been set which should not be exceeded. Checks should be made to ensure that the new sale, when added to the amount currently owing, does not take the customer over their credit limit. It would also be sensible to check that there have been no problems recently with receiving payment from this customer. If the checks are satisfactory, then the credit sale can go ahead. New customer. If a new customer asks for credit from your business, then it would be normal practice to ask the customer to supply some trade references, names of other businesses that they trade with on credit that can vouch for their creditworthiness. Your business may also wish to check the customer's creditworthiness through an agency, or by asking for references from the customer's bank. If satisfactory, a credit limit will be set for this customer, and the sale can go ahead. 1.5 The accounting system. A business may enter many transactions daily. It is quite clear that keeping track of all these transactions can be a detailed process. To ensure that a business does keep track of all sales earned, purchases and expenses incurred, the transactions are recorded in an accounting system. Overview of the accounting system. Initially, a business transaction will take place as a credit sale, a credit purchase, a cash sale, a cash purchase, another expense either paid from the bank or by cash, cash paid into the bank, withdrawal of cash from the bank and owner's drawings. A business document will be produced, e.g. an invoice. The transaction and details from the business document will be entered into the books of prime entry. A book of prime entry is where a transaction is first recorded. There are several books of prime entry which may also be referred to as e-day books. The transactions that have been recorded in the books of prime entry are transferred into ledger accounts on a regular basis. Ledger accounts are used as part of the double entry accounting system. A trial balance is a list of all the ledger accounts in the accounting system and is used as a control to check that transactions have been recorded correctly in the double entry system prior to the preparation of the financial statements. 2.1 Overview. The main document flows for a credit transaction are illustrated below. The various documents are described in the sections that follow. Price quotation. It is widespread practice to quote prices on a website if there is a standard price list from which there are no variations. However, some businesses will be prepared to offer certain customers goods at different prices or offer a discount. Therefore, it is often the case that a price quotation is sent out to a customer showing the price at which the goods that they want can be bought. The price quotation is an important document as this is the price that your organization is now contracted to sell the goods at. Therefore, it is important that it is authorized by an appropriate person in the organization. Discounts. A discount is a reduction to the price of the sales of goods or services. There are diverse types of discounts that may be given or offered for varied reasons. A trade discount will appear on the invoice. It will be deducted from the list price of the goods before VAT is calculated. The calculation of the trade discount on the face of the invoice should be checked, and it should be agreed that the correct percentage of trade discount has been deducted. A bulk discount must be checked to the agreement between customer and supplier to ensure that the correct discount has been deducted. The deduction of a bulk discount will appear on the invoice, deducted from the list price before VAT is calculated. Prompt payment discount. The details of the prompt payment discount are normally shown at the bottom of an invoice. It is up to the customer to decide whether to pay the invoice early to benefit from the prompt payment discount. No deduction will occur for a prompt payment discount on the invoice, it will just be offered to the customer. The agreement between the customer and supplier should be checked to confirm that the correct percentage of prompt payment discount according to the terms has been offered. A trade discount or a bulk discount is a definite reduction in price from the list price. A prompt payment discount is only a reduction in price if the organization decides to take advantage of it by making prompt payment. An order may be via a website, telephone, email, or it may be in writing. It is important to check all the details carefully. Does the price agree to what was quoted to the customer? Are the delivery terms acceptable? Are any discounts applicable? A typical purchase order follows. Note that the purchase order has been authorized by an appropriate person in the customer's organization. For confirming sales orders. A supplier normally confirms a customer's order with a sales order to avoid misunderstandings. A sales order confirms the terms on which goods will be sold, including quantity, type of goods or service, date of supply and delivery address, price and payment terms including any discounts given or offered. Delivery notes. When negotiations over the price and terms of the credit sale have been completed, then the goods will be delivered. Delivery notes should have sequential numbers that are either pre-printed for a manual system or computer-generated in a computer system and should be used in order. Spoiled or scrapped delivery notes should be cancelled and retained. There will normally be 3 parts to a delivery note. Part 1, the customer keeps this to compare to the purchase order and then to the sales invoice. Part 2, this is signed and returned to the supplier of the goods as evidence that the goods have been received by the customer in good condition. Part 3, this is signed and kept by the delivery organization, such as a courier, as evidence that they have delivered the goods and that the customer has received them. 2.6 Goods Received Notes. The goods received note is often compared to the purchase order as part of a payment authorization process. The information that a goods received note contains includes supplier name, quantity, type of goods or service, the associated purchase order reference and delivery note number, the name and reference of the carrier for delivery if different from the supplier. 2.7 The sales invoice. When the goods have been delivered, the seller must prepare and send out the sales invoice. In a manual system, sales invoices must be prepared from the details shown on delivery notes. Price, discounts, and VAT are shown on the sales invoice, with a VAT registration number if applicable. Sales invoices should have pre-printed sequential numbers and should be used in order. Spoiled or scrapped sales invoices should be cancelled and retained. In a computerized system, the sales invoice will normally be produced at the same time as the delivery note and will be identical except that the delivery note may not have details of price, etc., and they are usually an assorted color to distinguish them easily. Pricing goods and services. Unit prices for goods or services are kept in expert files, which must be updated regularly. If a price quotation has been sent to a customer, then this must be used to determine the price to use on the invoice. Prices will normally be quoted exclusive of value-added tax, a VAT, as this is the true selling price to the business. (2.8) VAT. Sales tax, VAT, is a tax levied on consumer expenditure. However, the procedure is that it is collected at each stage in the production and distribution chain. Most businesses, being taxable persons as defined later, avoid having to treat VAT as an expense as they may deduct the VAT they have paid on their purchases, input tax, from the VAT they charge to customers on their sales, output tax, and pay only the net output tax to the tax authorities, Revenue and Customs. Taxable supply of goods and services. Taxable supply is the supply of all items except those which are exempt. Examples of exempt items are as follows. Certain land and buildings, where sold, leased, or hired. Insurance. Post office postal services. Admission charges to museums, art galleries, etc. Betting, gaming, and lotteries. Input tax cannot be reclaimed where the trader's supplies are all exempt. Rates of VAT in the UK. There are 3 rates of VAT on taxable supplies. Some items are 0 rated, like exempt except that input tax can be reclaimed. There is a special rate of 5% for domestic fuel and power, and all other items are rated at the standard rate of 20%. Examples of the 0 rated supplies include water and most types of foodstuffs, i.e. not hot food, and not eating in a service is also provided, which is taxable. Books and newspapers. Drugs and medicines. Children's clothing and footwear. Non-deductible VAT. VAT on some items is non-deductible. This means that VAT on any purchases of these items can never be deducted from the amount of tax payable to HMRC. The business must bear the VAT as an expense. Non-deductible items include For our purposes, you will normally be dealing with taxable supplies at the standard rate of 20%. A taxable person is any individual, partnership, company, etc. who intends to make taxable supplies and is liable to register. A person is liable to register if the value of taxable supplies exceeds a specified amount in a 12-month period. Most companies and partnerships and many sole traders are liable to register. VAT exclusive amounts: if you are given the net price of goods, the price excluding VAT, then the amount of VAT is 20/100 of this price. Note: mathematical rules of rounding should be applied. VAT inclusive amounts: if a price is given that already includes the VAT, then calculating the VAT requires an understanding of the price structure. VAT calculations and discounts. VAT is calculated after trade and bulk discounts have been deducted from the original list price. Prompt payment discounts are only offered on an invoice, so it does not impact the VAT calculation at the point of the invoice preparation. If the customer goes on to take advantage of a prompt payment discount offered, the VAT amount is adjusted. This is looked at in more detail later in this text. (2.9) Preparing a sales invoice. To prepare the sales invoice, the customer expert file must be found. This will show the details of any discounts given or offered to this customer. The purchase invoice. When the customer receives their purchase invoice from the seller, several checks need to be made before it can be passed for payment. Order and receipt of goods. The purchase invoice received must be agreed to the purchase order, the delivery note, and goods received note. This is to ensure that not only is this an invoice for goods that were ordered, but also for goods that were received. Check the description and the quantity of the goods per the invoice against the purchase order and delivery note. For example, suppose that the purchase order for goods shows that 100 packs were ordered, and the delivery note shows that 100 packs were received. If when the invoice arrives it is for 120 packs, then the supplier should be politely informed of the error and a credit note requested to rectify the discrepancy. Calculations. All the calculations on the invoice should also be checked to ensure that they are correct. This will include the following. All pricing calculations. Any trade discount or bulk discount calculations. The VAT calculation. The total addition of the invoice. Other terms found on invoices. You may also find other terms and conditions shown on invoices or other documents. Here are some of the more common E&OE errors and omissions accepted. The seller is claiming the right to correct any genuine errors on the invoice, e.g. prices, later. Carriage paid, the invoice value includes delivery of the goods to the customer's premises. Ex works, prices quoted do not include delivery to the customer's premises. The customer must organize and pay for the delivery of the goods. Cash on delivery, the customer is expected to pay for the goods when they are delivered. For credit note. Businesses normally issue credit notes for any of the following reasons. When a customer has returned faulty or damaged goods. When a customer has returned undamaged goods by agreement with the supplier. For a refund to make a refund for short deliveries. To settle a dispute with a customer. To adjust an account after taking advantage of a prompt payment discount. A credit note is the reversal of all or part of the earlier invoice value. Credit notes are issued as documentary evidence that goods have been returned and that all or part of a previous sales invoice is cancelled. Therefore, a business must keep strict control over the credit notes it raises and issues. Return of goods. When a customer returns goods for any of the reasons mentioned previously, the return of goods will often be accompanied by a goods returned note. The contents of a goods returned note are like a goods received note, but with the added detail of why a return is being made. When a supplier receives returned goods, they must be inspected, counted, and recorded on receipt. They would normally be recorded on a return inwards note. From the perspective of a customer who is returning goods and consequently receives a credit note, the same checks should be made on credit notes as on invoices. The reason for the credit notes and the amount that has been credited should be checked, along with all the calculations and the VAT. Authorizing credit notes. All credit notes must be authorized by a supervisor prior to being issued to the customer. Some credit notes may be issued without a returns inwards note. For example, an error may have been made in pricing on an invoice, but the customer is satisfied with the goods and does not need to return them. These credit notes must be issued only after written authorization has been received from a supervisor or manager and must be reviewed and approved before being sent to the customer or recorded. Preparing credit notes. A credit note is effectively the reverse of an invoice and therefore will tend to include all the details that would normally appear on a sales invoice. 3.1 Introduction. Coding is used within an organization to provide an efficient and accurate way of referencing customers, suppliers, products, and other accounts within the accounting system. Codes are used in accounting records and the accounting system, within day books, sales and purchases ledgers, and other business documents. A code can be an alphabetical, numerical, or alphanumeric identification system. Customer files will normally be filed alphabetically by name or alphanumerically if part of the name is used within the code combined with a number allocation. Sales invoices tend to be filed in sequential order based upon invoice number. Invoices should be coded to show O product group type for analysis of sales and purchases. O customer supplier account number. There are several different systems of coding which can be used by a business. .2 Sequence codes. Allocate a number, or a letter, to items in a simple list. For example, code name 01 Adams, Joan. 02 Aitken, James. 03 Alcock, Frida. 04 Brown, Joe. .3 Block codes. These allocate bands of numbers to categories. For example, consider a furniture manufacturer who produces several types of tables, chairs, and entertainment units. A code could be assigned to each brand as follows. .for significant digit codes. These are a particular type of group classification code where individual digits and letters are used to represent features of the coded item. The example given is one used to describe various kinds of vehicle tires sold by a garage. .5 Facet codes. Facet codes are another type of group classification code by which the digits of the code are divided into facets of several digits and each facet represents some attribute of the item being coded. These codes are like significant digit codes but are purely numerical. A typical code would be 2.03.02 representing a twist carpet in 80% wool, 20% nylon, pattern fig leaf and color bright yellow. Note that a two-digit facet allows up to 100 different codes, 00 to 99. .6 Decimal codes, or hierarchical codes. These are yet another form of a group classification code. The most obvious example of a decimal code is the Universal Decimal Code, UDC, devised by Dewey and widely used for the classification of books in libraries. UDC divides all human knowledge into increasingly detailed categories as shown. Whatever the coding system used, it is important for accounting purposes that the invoices and credit notes are coded according to type of sales and the customer. You may be expected to code items such as sales invoices or credit notes according to a coding system that is given to you in an assessment. For point 1, the Sales Daybook, SDB. In a typical business, there will be numerous sales transactions to be recorded. Credit sales are recorded in the Sales Daybook. We will review how cash sales are recorded when we study the cash book. In its simplest form, the SDB will comprise just the names of the customers and the amount of the invoices issued in a particular week. The SDB is a list, the totals of which are used to perform the accounting entry. An example of a SDB is shown below. The Analyzed Sales Daybook. The Sales Daybook usually includes analysis columns showing how the total value of each customer's invoice is made up. The Date column contains the date of the transaction. The Customer column contains the name of the customer. The Reference column may contain the code number of the customer's account. The Invoice number is the number of the invoice issued for this sale. The total column is the total value including VAT of the goods sold as shown on the invoice. Product 1, 2, etc. columns. These are columns that analyze the net sales value, i.e. the VAT exclusive amounts, into groupings that are of interest or use to the business. The columns may be categorized by product codes. The total boxes. At the end of a period, say a week or a month, the sales daybook is totaled, and the total values of each column are included in the total boxes. It is these totals which are used for the accounting entry. For point 2, the Sales Returns Daybook, SRDB. Sales returns are in practice entered in a Sales Returns Daybook. This is like the Sales Daybook, and the columns are used in the same way. The only difference is that instead of having a column for the invoice number, there is a column for the credit note number. This is because when the goods are returned to the business, it will issue a credit note to the customer. In some businesses, the level of sales returns is low, and therefore it does not justify keeping a separate sales return daybook. In these cases, any credit notes that are issued for sales returns are recorded as negative amounts in the sales daybook. For point 3, the Purchases Daybook, PDB. As seen earlier in the chapter, credit sales are recorded in that sales daybook. In the case of credit purchases, we have the Purchases Daybook. In its simplest form, the Purchases Daybook will comprise just the names of the suppliers and the amount of the invoices received in the week. The PDB is a list, the totals of which are used to perform the accounting entry. A Purchases Daybook will look something like this. The Analyzed Purchases Daybook. The Purchases Daybook usually includes analysis columns showing how the total value of each supplier's invoice is made up. The Date column contains the date of the transaction. The Supplier column contains the name of the supplier. The Reference column may contain the code number of the supplier's account. The Invoice number is the number of the invoice from the supplier. The Total column is the value of the goods purchased including VAT. The VAT column. This column is the value of the VAT on the invoice. Product 1, 2, etc. columns. These are columns that analyze the net purchases value, i.e. the VAT exclusive amounts, into groupings that are of interest or use to the business. The columns may be categorized by product codes. The total boxes. At the end of a period, say a week or a month, the Purchases Daybook is totaled, and the total values of each column are included in the total boxes. It is these totals which are used for the accounting entry. For point for the Purchases Return Daybook, PRDB. Purchases returns are in practice entered in a Purchases Return Daybook. This is like the Purchases Daybook, and the columns are used in the same way. The only difference is that instead of having a column for the invoice number, there is a column for the credit note number. Purchases returns in the Purchases Daybook. In some businesses, the level of purchases returns is low, and therefore it does not justify keeping a separate purchase return daybook. In these cases, any credit notes that are received for purchases returns are recorded as negative amounts in the Purchases Daybook. If this is the case, then you will be told that this is the policy of the business. Care should be taken, however, when adding up the columns in the Purchases Daybook, as any credit notes must be deducted rather than added. For point 5, the Cash Book, CB. There are various forms of cash book, a 2-column and a 3-column cash book. Introduction to bookkeeping requires you to be able to post transactions into a 2-column analyzed cash book. You may hear about a 3-column cash book. This is not within the introduction to bookkeeping assessment criteria. The difference between a 2-column cash book and a 3-column cash book is that a 3-column cash book incorporates discount columns. As part of Introduction to Bookkeeping, you deal with discounts in their own day books, the discounts allowed and discounts received day books, which are introduced later in this chapter. The 2-column cash book. A pro forma 2-column cash book is shown below. Notes. The left-hand side of the cash book records money received. The right-hand side of the cash book records money paid out. The date column contains the date of the transaction. The narrative column describes the transactions, typically the name of the customer who is paying or supplier who is receiving money. It would also contain the sales ledger or purchase ledger code of the credit customer, receivable, or credit supplier, payable. The cash column on the left-hand side, debit side, represents cash received, whereas the cash column on the right-hand side, credit side, represents cash paid. The bank column on the left-hand side, debit side, represents money received by check or other bank payment, whereas the bank column on the right-hand side, credit side, represents money paid by check or other bank payment. A business may operate a bank current account to settle business transactions. Receipts may be made automatically, in the form of a check, or cash may be deposited into the current account. Payments may be made by drawing a check against the current account or by an automated payment. To be able to record these bank-specific transactions, a separate column must be introduced to the cash book to account for them. This is what leads to the use of a two-column cash book, a column for cash transactions and a column for transactions made through the bank current account. Each column represents a separate account, cash account and bank account, each with its own double entry, as will be shown later in the text. The cash book may be split into two separate books, the cash receipts book and the cash payments book. In addition to being aware of the use of separate cash receipts and cash payments books, you should also be aware that a cash book may have additional columns for the purpose of analyzing the receipts and payments. A pro forma analyzed cash payments book is shown below. Notes. The date column contains the date of the transaction. The narrative column describes the transactions. The reference column may include a reference to the source of the information, or the code of a supplier being paid. The cash payments book may have a total column which contains the total cash paid, whether it is paid through the bank, check, or cash, or it may have separate cash and a bank columns to show the method of money paid. A cash payment would be recorded in the cash column, whereas a payment made by check or another form of payment via the bank would be recorded in the bank column. The VAT column contains the VAT on the transaction, but not if the VAT has already been entered in the purchases daybook. The payables column contains any cash paid that has been paid to a payable, credit supplier, in payment of an amount owed to the payable. The cash purchases column contains cash paid for purchases that are not bought on credit. This would be the VAT exclusive amount, net. The VAT element would be accounted for in the VAT column. We saw with the analyzed cash receipts book that all receipts come from receivables or cash sales. In the case of payments, there is a broader range of suppliers who are paid through the cash book. Rent and rates, telephone, electricity, marketing, etc. The business will have a separate column for the categories of expense that it wishes to analyze. For point 6, the discounts allowed daybook. The purpose of the discounts allowed daybook is to record the credit notes that must be issued due to the customer taking advantage of a prompt payment discount that has been offered. The credit notes deal with the reduction to the original goods value, net amount, and the reduction in the VAT. The total, gross amount, is then deducted from the receivables, credit customers, balance. The discounts allowed daybook is a list, the totals of which are used to perform the accounting entry. Notes. The date column contains the date of the transaction. The narrative column provides details of the customer's name. The reference column may include a reference to the source of the information, the credit note, or the customer code the transaction relates to. The total column contains the total discount that has been allowed to the credit customer, including any VAT. The VAT column contains the VAT element of the transaction. The net column contains the amount of the discount excluding the VAT element. For point 7, the discounts received daybook. The purpose of the discounts received daybook is to record the credit notes that have been received due to the business taking advantage of a prompt payment discount that was offered. The credit notes deal with the reduction to the original goods value, net amount, and the reduction. In the VAT, the total, gross amount, is then deducted from the payables, credit suppliers, balance. The discounts received daybook is a list, the totals of which are used to perform the accounting entry. Notes. The date column contains the date of the transaction. The narrative column provides details of the supplier's name. The reference column may include a reference to the source of the information, the credit note, or the code of the supplier the transaction relates to. The total column contains the total discount that has been received from the supplier, including any VAT. The VAT column contains the VAT element of the transaction. The net column contains the amount of the discount excluding the VAT element. For point 8, the petty cash book. A typical petty cash book is set out below. This is a typical petty cash book that is in the format of a ledger. A petty cash book that also forms part of the double-entry bookkeeping system. Petty cash receipts. The receipt side, left-hand side, of the petty cash book only requires one column, as the only receipt into the petty cash box is the regular receipt into the petty cash box of cash withdrawn from the bank account. Referring to the example of a typical petty cash book at above, we can see that the balance brought forward, representing the opening balance, was £35.50. The petty cash float has then been restored up to £150 by paying in an additional £114.50. Petty cash payments. Payments out of the petty cash float will be for a variety of diverse types of expense, and an analysis column is required for each type of expense in the same way as the cash payments book is analyzed. The example above has analyzed the expenses into postage, cleaning, tea and coffee and sundry expenses. Note that a column is also required for VAT, as if a petty cash expense includes VAT, this must also be separately analyzed. In addition, it is important to remember that any VAT included in a petty cash expense must be shown separately on the petty cash voucher. Any VAT shown on the petty cash voucher must be analyzed into the VAT column and the net amount shown in the appropriate expense analysis column.